Hey everyone, welcome to the KE Report, a daily editorial on Monday, October 20th, chatting with Craig Hemke. Craig is the founder and editor of TF Metals Report. Craig, as we always do, let's chat about the precious metals market. And boy, oh boy, what a volatile week last week, especially at the end of the week. And then starting off this week with a nice rebound. Gold was just pushing higher last week. Silver was really spiking higher. And then on Friday, big correction, I guess we can say, but it was only a 1 day correction. Silver was down, I believe, over $2. Gold was also down well over $100. Today, they're all bouncing back. Gold's up about $150. Silver is up about $1.25. The stocks really are what caught my eye. We had GDX, I think it was down almost 8% at one point on Friday on huge volume. We saw big volume into all of the ETFs that follow the gold and silver stocks. Those are also rebounding today, not to the same extent that they dropped on Friday, but again, it seems like that was a very quick drop in still this very bullish market. What do you take away from what happened at the end of last week, Craig?
Well, it was you could lay it at a number of things. And hi, guys, by the way. Gold was pretty heavily overbought on the daily RSI, as was silver. Which always leaves you ripe for profit taking and pullbacks. I'm sure that had a lot to do with it. But frankly, I think a lot of it had to do with option expiration. The monthly options on the New York Stock Exchange expire the third Friday of every month. And look, I don't know. I do this, watch this stuff for a living. And to me, it's no coincidence that many times we come under pressure on those days, especially in bull markets. This last month, since the previous option expiration, had been pretty much straight up, not only in gold and silver, so that translates to the GLD and the SLV, but also in all the shares. And so we entered the week last week with, literally millions and millions of calls, whether it's on those ETFs or on the mining shares that were deep in the money. Silver, the SLV, I should say, finished Thursday north of 49. It closed Friday below 47. And that took something almost like 200,000 calls out of the money while putting into the money less than 5,000 puts. So I don't know. Coincidence? Maybe. But when you look then at the end of the day, as you mentioned, Corey, the GDX down 7%, some of these shares down more than that. But yet by the time we got to the Globex weekly close, which is 5 o'clock Eastern time, 1 hour after the New York Stock Exchange closed, gold went even down 1%. It rallied back, some $50 Friday afternoon. So that sure made it look like that was all overcooked on Friday. We've bounced back some today in the shares. I would suspect the dips are going to continue to be bought ahead of this earnings season. And eventually we're going to get into a consolidation pattern. That might have started on Friday. But for now, it looks like that was a one-day event and leaves you wondering what the rest of this week will bring.
Well, it sure was a wild one on Friday, and I had a lot of people, Craig, that emailed me because their accounts were down so much in one day, and I had the same experience. It was just a really outsized move in the stocks. It was just startling after such a weird week. But hey, we didn't even get to celebrate with you last week that silver broke $50. So can we pan back for 1 second and just realize that after 45 years of waiting, and as fellow silver bugs, silver finally broke 50, and it didn't just go up and tag it, midday and then retreat. It stayed above 50 most of the week, and it also had a backwardation factor in the physical, being a buck or two ahead of the futures market. We never got to unpack that with you. So what do you think of silver's meteoric rise to finally break out to new highs?
Well, as you're asking me that question, Shad, I dug out my notes from the podcast I recorded for the members of my site back on Saturday morning. Everybody is doom and gloom and, oh God, oh, woe is me and everything, because those were big numbers on Friday. But for the week last week, right? Well, it was gold, like I said, only down $37 by the time it was said and done. But even through the COMEX close, if you want to go COMEX close to COMEX close, Friday the 10th through Friday the 17th, even if you post the COMEX close last Friday of 42.13, gold was up $211, even including Friday. Silver was up $2.84, even including Friday. The GDX was up $2.95. even including Friday. It's like the meme that you see on X. I use one with Walter White, where what's the dude? Cranston, right? And they show him when he's playing the dad and Malcolm in the Middle, and he's all smiley. And then the next one is him as Walter White. And it's like, here's silver at $49 2 days ago, and here's silver now. I mean, we get so focused, because of what happened in the last couple of days. Yes, silver now above 50. You could also look at Friday and say, well, let's see, 50 is pretty significant resistance. It broke through and then pulled back and tested that resistance as support, which is almost always happens in anything. When we got down to 49.60 or brief 60 or whatever it was briefly Friday afternoon before it recovered to 50.60 by Friday's Globex close. So yeah, it is significant that it's staying above 50. The longer it stays above 50, the higher likelihood that some momentum starts chasing it again and it keeps moving higher. So we'll want to watch that 50 level all week long because that's pretty important for more than just psychological reasons.
Hey, it is crazy. Even at the end of last week, as you said, just even the weekly candlesticks were still up. So something crazy to look at and just consider. And we need to understand that the biggest single down days come in bull markets and the biggest single up days usually come in bear markets too. So it's kind of bull market action. But Craig, you just mentioned something there where if silver stays above 50, turns into that momentum trade. We're hearing a lot more that gold and silver and the underlying equities are simply a momentum trade right now. It sounds like a lot of retail, a lot of speculators are truly pushing these prices higher because we haven't seen many changes in some of the longer term buyers. Some of those central banks just are consistently buying gold, but this really skyrocket higher in the metals prices, especially how much silver have moved, have people saying that this is a momentum trade. What do you have to say to that?
Yeah, let's see, this was back on Friday the 10th, and I was trading some text messages with my old friend Ned Naylor Leyland. Ned runs precious metals and mining share fund out of London. He's the guy that famously coined the term the future's tail wags the spot dog. So as we were trying to close above 50, again, this is 10 days ago, we're talking about what is this? Everybody's wondering, is this just like 2011? Are we going to get smoked backward this weekend? All that kind of stuff. And Ned said, no, it's not, because the amount of the commodity trading funds, the CTAs, you'll hear them referred to as, that chase that momentum is multiples more than it was. I mean, I don't even know if there were very many of those even in existence 15 years ago. He said, so that's the kind of the worst nightmare for the shorts at this point, is that these CTAs just keep piling more and more money. Remember, we've talked about this before about how silver kind of creates its own momentum. How it'll sit there forever and then all of a sudden it starts moving higher and then it creates some momentum. People get excited because they notice, and then more people plow in and it moves it higher, and more people plow in and moves it higher. The only other side to this is that obviously we don't get commitment of traders reports at present because of the U.S. government shutdown. And even if they come back, I don't know, later this week or next, it's going to be November before we even get the report that was surveyed at the end of September. I mean, there's a lot of catching up to do. We can watch the open interest levels every day, but that's not extreme. I mean, even in gold, gold's open interest as of Friday's close was 487,000 contracts. Well, geez, guys, even back 15 years ago when gold was, that summer of 2011, it was 550, 600, 610,000 contracts. So where'd all these market participants go? So anyway, long answer to your short question, Corey. Yeah, I think it is making its own momentum on kind of a FOMO trade. And that's why holding 50 is important. Ned thought getting above 50 would be a real positive reinforcement for that trade. I think now holding 50, God forbid, moving through the Thursday evening highs could really set a fire under it again.
Well, Craig, I need to get you to weigh in on the backwardation that we're seeing between the spot silver price and the future silver price. We haven't seen this very often, And I know you like to get in under the hood and look into this. I have had a lot of people emailing me what I think about it, and I don't really have a lot of thoughts. I've seen a ton of articles and a lot of people with opinions on it on social media. But what's your hot take on the physical getting a premium to the futures?
Well, let me first state this. There's a knee-jerk reaction of people that don't really follow the metals that say, well, how can there be a shortage? I can go into my local coin shop or I can go online and they'll sell me. There's no shortage. That's not what we're talking. Ounces at your coin shop are not what is in short supply. It's tonnage in London, where the entire system operates on pledged, collateralized, hypothecated and rehypothecated, unallocated metal, which, is fine as long as you don't have more people wanting delivery than people that are willing to trade that stuff. And that's what the problem is. The backwardation. Think of this. Remember earlier this year, beginning in late January, early February, we had the opposite happen. We had this big wide premium in contango where the spot price of silver was, say, 35, but the futures, the front month futures, was 36. And that was indicative of a potential arbitrage, and where the metal was seemingly abundant in London, but short in New York. And the arbitrage trade that was slow to develop, but eventually happened, was you sell in London, take delivery, and you fly it over the U.S. and deliver it there. Buy there, buy in London, sell in the U.S., close that. I think I misspoke. You buy in London, you sell in the U.S., manually close that ARB window, and you saw it actually play out with the amount of silver that flowed into the COMEX vault between February and maybe May. Okay, now you got the opposite. You've got spot in London higher than the futures prices in New York. And it means the opposite. The metal's in New York, the shortage is in London. How do you close it? Just the same way. Okay, you buy in London and you sell in New York and you take the metal out of New York and you ship it back to London. Problem is, can you do enough of that? Can you do that fast enough? Is there confidence in executing that trade to put the trade on in the first place? Apparently not, because we persist even today at anywhere from $1 to about $1.40 of that. I mean, we'll call it backwardation, we'll call it negative spread, whatever you want to call it. And again, it's indicative of a shortage on that end of the trade. And it'll be interesting to see how it resolves itself.
So over history then, Craig, when we have seen this happen in the market, what's happened following that? Where have prices gone?
Well, see, it's extraordinarily rare for that, because usually futures boards are contango because the time value of the whatever product you're dealing with, the spot price is usually the lowest. And then as you go out with futures to December and March and July and September and December, and you go out the contract, you're higher and higher prices. So backwardation is what's unusual, to have spot higher than futures. And it's very rare that it happens. And whenever it has happened, even if it's just for a couple of days in the past, it gets quickly resolved. And that's what's so odd. This developed, I think it was October the 2nd. The morning of the 2nd was when because silver had been trading 15, 20 cent contango, which is appropriate for the front month being December, going off the board end of November. Gold remains in contango about $15 from spot up to the December gold. But silver moved into this 15, 20% backwardation that day and has been in that persistent state. The worst it got was that Friday the 10th when it almost got to $3. There was some selling last week that I saw it briefly drop under $1, but again, it remains. Which again, so I just can't emphasize that enough. This is not, people get online and say this is, people try to create some kind of narrative of silver and shortage. There's no shortage. I can go online and buy an ounce. Knock yourself out. Of course you can, and you should be buying that ounce. This is not an ounce problem. This is a tonnage and leverage problem. And that's why it needs to continue to be monitored.
Well, Craig, just another question on silver and gold in relation to the mining stocks. The metals have moved up so quickly, And a lot of people say, well, yeah, the mining stocks have moved up too, but not really on a percentage basis based on how much their margins are expanding at these higher prices. If you think about how impactful a $1 move is in silver to any of the silver producers or primary silver credit producers, it's a big deal. $2 is a big deal. When you start moving up by 3, 4, $5 in a week and you start seeing these kind of moves and where silver prices are today, do you think that people are able to keep up with their valuations on these companies when metals prices are moving this quick?
No, again, I keep doubling back to things that I know we've talked about in the past, and I'm not saying you guys don't keep track. I'm just saying these are little arcane points that I think need to be brought up from time to time. Think of the analysts at the sell side firms that cover, say, Newmont. Just pick one. That guy thinks, he's monitoring Newmont, he's calling them up and he's trying to figure out, how they're managing their costs and their plans and all that kind of stuff. But then when he comes up with his earnings estimates, he's got to go to his banks or his firms, commodity analyst, and then look at whatever they're projecting for the price. And then that's how he's going to come up with his earnings estimates for this year and next. Well, these banks and these firms are still barely catching up. So, yeah, some of them are starting to say $4,000 gold or $4,600 gold. But a lot of them are still, putzing along in 3,000 something for next year. Now, maybe they'll be right. I don't know. But this is impacting earnings forecasts and how aggressive then institutions and even retail are in assessing where these stocks are going. You're absolutely right. I mean, what was for the third quarter, which was just completed 3 weeks ago? I'd have to go back and look. I mean, you could probably eyeball a chart and come up with what the average silver price was. 35? I'm just guessing. I haven't looked at it. I just can't remember. The 35 is great. And all these silver producers are going to show tremendous margins and earnings when they start reporting next week. But what are they going to do if they average 50 here in the fourth quarter? And all this talk about everybody's long and all that kind of stuff, I can assure you, everybody is not long. And those stocks are not fully priced in or reflecting any proper value for $50 silver. They're just not. So buy the dip. How's that? That's probably the best strategy there is.
Buy the dip. There you go. But Craig, on that comment, look, we talked Newmont. I know how much you dislike talking Newmont, but in under 3 months, Newmont is up almost 50%. So how do you balance that out with the moves in the metal?
Well, again, it's not, it's like, how we always talk about moves in the shares are like, yeah, they move into the big ones first. And then later in the bull market, then the juniors catch fire. And then the expiry, remember that's always kind of been I guess, kind of the national way everybody looks at it. Well, the big ones move and Newmont is moving because I mean, I don't mean to just speak in anecdotal terms, but if some guy calls up his stockbroker and says, hey, do we have any exposure to gold? And because it's $4,000 an ounce, and the stockbroker's like, no, I don't get any trailing commissions on gold, but I can sell you Newmont. And surely, I mean, his company may not follow, other big stocks, but they follow Newmont and Barrick. And he looks up, punches on his screen, and it says, oh, look, we got a buy rating on Newmont. I can actually sell it to him and not worry about getting in trouble. And so you get this early stage move where companies like Newmont and Barrick have been perking up. That's just part of this that I think is getting lost, because I think we might have talked about this 2 weeks ago. The frustrating thing is, well, how come some of these juniors aren't going yet? Or, the GDXJ is still way off its all-time highs. Or how come some of these exploration companies, you'd think at $4,000 gold would be going great. And I'll tell you why. I think it's still so early. We're not at that phase yet where we move past the large caps and into the mid caps. We're certainly not at that stage where we move past the mid caps into the exploration companies. So I think that's actually a sign that this is, what's the baseball analogy? I mean, bottom of the second, something like that. Still a long ways to go.
Well, Craig, it's one of those things too where, again, it's easy to look at a chart and say, hey, look, this gold stock or the silver stock is up a lot. Okay, but when you think about margin expansion, it doesn't happen on a one-to-one ratio. It's not like if silver goes up $1 or gold goes up $50 that it's just an even Steven. Their margins are expanding at an exponential rate at these prices. And if you look at the economics on a development project, it's a huge multiplier. Again, every $100 in gold or every dollar in silver has an outsized effect, and it starts drifting up so quickly that we hadn't even really fully processed $3,500 gold or the silver in the 40s. We skipped over the 40s. Now we're already in the 50s. And it's like, I don't think the company's even caught up to where they were there. So could that mean not just that we're in the early innings, like you say in the basement analogy, but that like a lot of people that think just because a chart's up and to the right that they've missed it could maybe talk to those people that feel like they've already missed the move.
Yeah, let's do this. Here's what I would do if you feel like you've missed the move, and maybe you're just always going to be chasing. But things don't go straight up. Corey mentioned earlier, big green candles again. We've had 9 consecutive green weekly candles in gold, silver, in the GDX. Okay, yeah, we might have 10, but we're probably not going to have 27. We spoke a couple weeks back in early September about how gold has moved up in this consistent pattern since it broke out above 2100 on March 1st of 2024. 20% rallies, 3 or 4 months of consolidation. 20% rally, 3 or 4 months of consolidation. We're right at 20% right now on this most recent rally that started in late August. So we're probably going to consolidate it. As for the shares, I'm getting to your question now, Shad. As for the shares, there's a kind of a rhythm to this. Okay, there's going to be people buying the dips, like we saw and are seeing now today, ahead of earnings. Newmont starts, Thursday night? And then it's, just multiple companies over the next couple of weeks. Investors like me are just going to, just continue to hold them. But traders are going to go, okay, well, that's it for the news now for a while. I think I'm going to take some profits. And so almost invariably in this rhythm, the shares, shortly after their earnings reports start to drift lower. Just more sellers than buyers at that point. With the buyers thinking, or the sellers thinking, well, I'll come back, next month, once we get a feel for where the next quarter is going to be. And that's exactly what happened. I mean, remember this last time, shares started to rally in August 1st, like the first week of August. And then the metals really took off at the last week of August, early September. That's probably about how it will go again, because if we get deeper into this quarter, right? We are now, 3 weeks in. We get to the middle of November, late November, okay? And let's just say the GDX is still at 80 or whatever it is now because it had gone up and then come back down or whatever. And we're still looking at $4,400 gold and $52 silver by late November. Well, then you can probably start to factor in how much money all of these miners are making at an average sell price, for the third quarter or for the fourth quarter of, $4,300 and $50. And all of a sudden the floodgates will open, and just like in August, here comes all the money again. So, that's a really long answer. I hope it made sense. If you've missed the train, then I would take my chances that there is a consolidation coming, probably after earnings. So during the month of November. And then once we get deeper into November, and if the prices stay where they are or go higher, then that'll be your chance to get in.
All right, we'll leave it there, Craig. Look, a lot of these stocks have made very nice moves if you have a short-term chart up, but if you go back on a long-term chart, especially the juniors, they really haven't moved that much. I know a lot of dilutions coming to those stocks, and the majors, some of which are at all-time highs. I believe some are still maybe a little bit off of all-time highs, which is kind of crazy to think about where the gold price is. But either way, I can see why some people would say, man, this stock has already gone 4, 5x, especially in the mid-tier and junior space. They might feel like they've missed it, so I guess wait for a correction, or at least just sometimes buy the stocks that are doing the right work, that have the catalyst outside of just this continued bull market in the metals. As always, Craig, good chatting with you, and everyone click that link in the show notes to go visit Craig's website, tfmetals.report.com. Craig, have a great rest of your week.
Thanks, guys.